Joining me now, Yardeni Research President Ed Yardeni. Ed, what does the future, what the U.S. economy look like to you for the coming year?
The year looks actually very good, especially when you compare it on a year-over-year basis to last year, and that's a lot of comparisons are done that way. But the reality is we had a remarkable recovery last year. A lot of that had to do with eliminating the lockdown restrictions that really knocked the economy for a loop back in March and April. And once the restrictions were lifted, it was kind of we all had cabin fever, and the best way to get out of cabin fever is to get out of the cabin and go shopping. But in addition to that, there was a lot of government checks sent out. This time around, we're going to get even a bigger round of checks. Last time it was $1,200 per person. This time around, it's going to be something in the order of $2,000. Some checks have already gone out for $600, and there's another $1,200 likely to go out once Biden is in the White House.
Brian Brentberg, jump in here. The Wall Street Journal editorial page writes this, that the Biden proposal is $1,400 checks for most Americans, quote, most of whom have jobs. The Journal editorial points out that's going to cost $400 billion or so with almost no larger economic benefit.
Yeah, Ed, I'm going to talk about the cash argument. You know, the markets are so excited about government cash coming their way. Obviously, Goldman Sachs raises its forecast. But at some level, you have to ask the question, you know, is the government cash strategy sustainable? I think most people who look at the situation objectively say, no, it's not. And by the way, people don't change their behavior that much based on one-time cash payments. They look ahead at permanent income, and the future of this country from a policy perspective doesn't look like more and more growth. It looks like more and more regulation. So, Ed, can you speak to that more cash argument for the market going up and why that might be very short-sighted, if you agree with that?
Well, there's no precedent for what we're seeing. I mean, there's no precedent, at least in our lifetimes, for this kind of pandemic situation, and there's no precedent for the lockdown recession, and there's no precedent for the extraordinary amount of cash stimulus that's been provided by a combination of fiscal and monetary policies. Some people call this modern monetary theory. It's basically fiscal and monetary policies gone wild, responding to the virus crisis with unprecedented amount of stimulus. And the reality is, I mean, the facts on the ground are that it did work. Last year, it was so much cash that, yeah, some of it was saved, but a lot of it was spent. And I think another round of cash that's even more than last time will also have a stimulative impact. The question is, you know, have we discovered free money? Why not more? Why even pay taxes? Let's not pay taxes. Let's just borrow the money. Obviously, there's got to be some crazy limit to what we're doing here. And I think that the risks we're taking is a melt-up in the stock market, which is great on the way up, but melt-ups are followed by meltdowns. I'm not in the camp that believes that inflation is going to make a comeback, but the bond market's starting to worry about that, and therefore I have to worry about that. I invented the term bond vigilantes back in the 80s, and the bond vigilantes have been buried, but they're not dead, and they could come back, and higher bond yields could really cause a problem for the economy.
I know Steve Forbes quickly has something to say about this, Ed. Steve?
Yeah, Ed, with all those trillions out there and more trillions to come, how do we avoid inflation coming? That's the real question. How do we avoid it?
Yeah, it's a very good question. I mean, you know, as you know, since the great financial crisis in 2008, we've been increasingly addicted to the drugs provided by the central banks, which is cash, cash, cash. And it hasn't caused inflation, at least on the consumer price level. It has caused asset inflation. I think we already have inflation in asset prices. And if you happen to own stocks and real estate and other assets, it's been great. But it's a good question, Steve. The honest answer is I don't know, but we're going to find out whether this kind of level of monetary and fiscal stimulus is finally going to be inflationary. I think there is a risk of that.
Ed, great to see you. Thank you so much for being here this morning, Ed Yardeni.
Thank you.